Deepak, I was talking to Vikas Khemani just before you joined us, and my question to him, and the same question to you, because it's good to get some realistic perspective on the markets as well, is that markets, most people believe, is frothy in the current sense of the way we see it. There's a widespread spike in valuations across sectors, across market caps. I mean, look at EVs, look at autos, traditional autos. Both sectors or both ends of the spectrum have done exceptionally well. Be it quick commerce, be it retail. Again, two opposite ends of the spectrum where you'll only have one winner, right? But both spaces of the markets are seeing buying and everyone's gaining. Are you concerned about valuations in this market? Before we go into the Fed-led rally, I want to understand from you any worries on valuations for the Indian markets, or foreigners are just not being as wise as us?
Yeah, I mean, I don't know the exact answer to that question about the foreigners part, but I'll tell you this from my experience. It's always that there are pockets of undervaluation and the pockets of overvaluation, right? So you've got a bunch of stocks overvalued probably 5 years ago, including the likes of maybe 4 years ago, likes of HDFC Bank, or the likes of a lot of the foreign-owned FMCG companies, where you gave 80 times and 100 times earnings for these companies, and come 3 years later they're at roughly the same prices or below, and earnings have gone up, but their stocks haven't done much. Meanwhile, another set of stocks which were probably undervalued at that time, maybe it was PSU, defense, manufacturing. A bunch of these companies have been undervalued for over a decade, and suddenly, because of certain structural changes and also because of investor interest, the stocks have gone up quite considerably, and now the fear is that, compared to their past, they are undervalued. To give you one example, and we own some of these stocks, there's let's say a Mazagaon dock which has been told that, it's terribly overvalued because it's gone up 6x in the last year. But it's also true that their earnings have increased and they're trading at maybe 35 to 37 times earnings, whereas a bunch of other companies like Hindustan Unilever or some of these other companies where the earnings haven't grown meaningfully even in the last decade, they're trading at 80 times earnings. So there is a feeling that if you ask somebody, they will tell you Hindustan Unilever is undervalued because it hasn't moved in the last 2-3 years, but Mazagaon dock is overvalued. So the valuation picture, I think we have a very high recency bias to price, but not a very strong hold on earnings or growth, which is why we tend to call something overvalued just because it's moved up in the recent past. But I would say that there are, even today, a lot of opportunities. Some manufacturing companies in India are probably, even though they have high PEs, the scale of growth is so large that they will be able to grow into their valuations relatively fast, and they've demonstrated it also over the last year or so. Prices are going to be high for some stocks, are going to be lower for the others. That's just us, I think, that have to look at it. And to be honest, just looking at it from the outside gives me a lot of satisfaction to hear that most investors are worried that the market is frothy. Because what you don't want is when most investors don't think that the market is frothy and they're still investing like crazy, and that is really when the bubbles burst. But when everybody's worried, it's usually a good time to invest.
Hi Deepak, good morning. Tamanna here. So if everyone is worried, it's a good time to invest. Right now, nobody seems to be worried. People are laughing off the valuations question. Is the reverse then true? But on a more serious note, let's talk a bit specifically about some of those sectors that you mentioned, and I want to come to the financials, to the banks, because those right now are not really in favor and could see the next cycle of up move. If yes, what are you liking in this space?
So typically there are some indications that, for instance, interest rates will come down because the USA may reduce interest rates at some point, and then India will likely follow. That should provide some kind of relief to banks, but they have to cut down their NIMs. In that sense, that the net interest margins being nearly 4% will not sustain over the longer term, because you have competition now in the form of NBFCs, people who are being able to give quicker loans, and the other banks as well. Even the PSU banks have started to fight back. So a large number of the private sector banks will probably have to reduce their NIMs. The NIMs are at tremendously high values, and also that is the only thing that you can use for growth. So I don't really care if your NIMs come down, but if you're able to grow 25% with a slightly smaller NIM, then so be it, because if you're going to grow at 0% with the same NIM, then it is of no interest to me. I think that is the philosophy looking forward. But, to be fair, there will be a time for this adjustment to happen. And till then, we're still into the larger banks, private sector banks. I probably missed the whole public sector bank rally, to be honest, because we were focusing on the larger private sector banks. But,
you will continue do an HDFC, Axis, ICICI still feature on that list?
Yeah, I think we've been positive on some of them. I own some of these guys, but I did own a few public sector banks, but then I got out much earlier because we wanted to shift to private sector banks. But unfortunately, the public sector banks have done much better since then. So,
quick question, Deepak: how do you feel about the oil and gas pack right now?
The All India, sorry?
Oil and gas sector.
Oil and gas, okay. Sorry, oil and gas. Yeah, oil and gas is a bit of it's been a very strange time. You had, all these wars and all that, and you're still seeing stable overall oil prices. We're positive on some of the public sector oil marketing companies, simply because I think they're long-term cash flow generators. But in general, the oil and gas sector is challenging because it's so cyclical in nature, and also because the cyclicality of it hasn't actually meaningfully altered the perceptions or revenues in the recent past. That means usually something is cyclical and it actually doesn't behave like it's in a cycle. That means some big moves are probably coming ahead. At some point, you're going to see a dip in transportation requirements of fuel. Recently in Germany, or I think in Germany it was, that you saw that renewables had flooded the energy market so much that power prices went negative for a while. Of course, the result of summer and solar being active and all that stuff. But increasingly, perhaps as we grow, transportation itself may move towards less usage of crude oil, and this is going to cause a dip in the market in terms of demand. So because it's so unnaturally well supplied and demanded at the same time, I think prices of crude oil will decrease, which means margins of companies in that part of the space, whether it's exploration or in the exploration space, will probably decrease. But I think marketing in India will continue, because I think we're going to see either hybrids or petrol or diesel-based cars for a long time from now.
Deepak, I'm going to have a public request, because Taman and me were just discussing that we need to have you on a half-an-hour sit-down conversation with us, and that should be before 11 a.m. So hopefully you can find time.
We've cornered you.
Yeah, we've cornered you publicly. So we'll hopefully connect back with you. But thank you very much for joining us this Monday morning. Always good to get perspective from you.